Please like, share, and subscribe. Wishing you happiness and good luck every day.
So you've seen the flashy Instagram posts, right? The Lambos, the laptops on the beach. But have you ever wondered what it actually takes to make it as a day trader? Well, today, we're going to crack open Andrew Aziz's book, Advanced Techniques in Day Trading, to get the real, unglamorous story behind the curtain.
This is the dream, isn't it? I mean, this is the picture that gets so many people hooked. Making a living lounging on a beach somewhere in the Caribbean, you can almost feel the sun. It's an incredibly seductive image, for sure.
Okay, so just as you're getting comfortable with that beautiful image, the author comes in and just shatters it. His message is super blunt. For a new trader, that dream, yeah, it's highly unlikely. The reality is a completely different world from that beach house daydream.
So, if it's not the beach house, what is it? Well, the entire foundation of the book is built on this one really crucial idea. Trading is a business. Simple as that. It's not a hobby, it's definitely not a get-rich-quick scheme. It's a profession, a career, and you have to treat it with that level of seriousness.
And like any business, you've got to invest in it. We're not talking about a crazy amount of money here, but the author figures a proper education, with the right software and simulator practice, is going to run you about $1,000 to $2,000, and that's before you even put a single real dollar on the line. It's basically your tuition for this new career.
Okay, so what do you get for that investment? The book breaks it all down into 3 essential pillars. These are the absolute foundation for a successful trading career. You've got mindset, tools, and strategy, and you really have to master all 3. So let's dig into the first one.
All right, pillar number 1, and this is by far the most important one, mindset. The author says what a lot of legendary traders say, success is like 80% psychology. Think about that. It's huge. And honestly, this is where most people who try trading fail. Why? Because it's a non-stop battle against your own brain, your own worst instincts. And to show you just how wrong our gut feelings can be, the book brings up a classic brain teaser. You've probably heard of it, the Monty Hall problem. It's famous because it has stumped some of the smartest people on the planet, and it's an absolutely perfect lesson for traders about probability. Okay, so picture this. You're on a game show. 3 doors. Behind one door is a brand new car. Behind the other 2, goats. You pick a door. Let's just say you pick door number 1. Now the host, and this is key, he knows where the car is. He opens one of the other doors, say door number 2, and shows you a goat.
So here's the big question. The host looks at you and says, do you want to stick with your first choice, door number 1, or do you want to switch to door number 3? Seriously, what's your gut instinct right now? Stick or switch?
And this is exactly where our intuition messes with us. Most people, their gut says, well, there are 2 doors left, so it's 50-50. It doesn't matter. But the math says something completely different. You should always switch. It's wild, but here's why. When you first picked, you had a 1 in 3 chance of being right. That means there was a 2 in 3 chance the car was behind the other 2 doors. The host didn't just open a random door, he opened a door he knew had a goat. So that whole 2/3 probability, it doesn't just vanish, it all gets concentrated on that one remaining door.
And that, right there, is the huge lesson for traders. The market is kind of like that game show host. It's always feeding you new information. Your first impulse, your gut feeling, might be to stick to your guns. But a pro trader knows you have to fight that emotional pull. You have to trust the probabilities, just like switching doors in the Monty Hall problem. Your strategy, that's your math, and you've got to stick to it even when it feels counterintuitive.
Okay, so once you start getting your head wrapped around thinking in probabilities instead of emotions, it's time to talk about the actual gear you'll need. This brings us to pillar number 2, the tools. This is the real nuts and bolts stuff, the software you'll be staring at all day to make your moves.
And here it is. Welcome to the cockpit. I know, it kind of looks like something out of a hacker movie, right? But this is what a pro trader's desktop actually looks like. It's a sea of data, charts, watch lists, news feeds, and right in the middle of it all is the montage. That's your command center. It looks overwhelming, I get it, but every single window here is telling you something important.
Let's zoom in on the most important part of that screen, the montage. This is basically your direct line to the market. On one side, you've got the bids, that's all the people trying to buy. On the other side, the asks, all the people trying to sell. It gives you a live, up-to-the-second look at supply and demand. This is where you actually place your orders, and you have to be precise.
Okay, now how you place those orders is a really, really big deal. The author has a huge warning here.
almost never ever use a market order. He calls it a blank check because you're just telling the market, give me whatever price is available, and that can lead to something nasty called slippage, where you get a way worse price than you expected. Now, a limit order is safer because you set your exact price, but the trade might never happen if the price moves away from you. So the author recommends a kind of best of both worlds option, the marketable limit order. You get the speed of a market order, but you still have that price protection. Super important.
Okay, so your head's in the game, you've got the right tools on your screen. Now, and only now, are we ready to talk about the final piece of this puzzle, strategy. This is your playbook. This is what tells you what to trade and when to trade it. But I gotta repeat this. A strategy is totally worthless if you haven't mastered your mindset and your tools first.
So the book gets into a bunch of different proven strategies. You can think of them as specific, repeatable patterns that traders look for on the charts. You'll hear names like the ABCD pattern or a bull flag. The whole point is to find a situation, a setup, where the probabilities are tilted in your favor. But in this is a huge but that the author just keeps coming back to. Spotting the pattern isn't the really hard part. I mean, thousands of other traders are seeing the exact same thing you are. The real skill, what really separates the pros from everyone else, is flawless execution. And where does that come from? You guessed it, it all comes back to your psychology and knowing your tools inside and out. So we've talked about mindset, tools, and strategy, the three pillars. But there's one more thing, a kind of glue that holds it all together. The book argues that the real secret to success isn't some magic formula. It's something much more fundamental. It's a human quality.
And the book tells these two amazing stories to prove its point. First, you've got Pete Best, the original drummer for the Beatles. He gets kicked out right before they become the biggest band in the world, and that setback, understandably, sent him into a deep depression. Now, compare that to Dave Mustaine. He gets kicked out of Metallica. He was furious, but what did he do with that anger? He went and formed his own iconic band, Megadeth. The difference wasn't talent, it was resilience. It was about taking a massive hit and not just getting back up, but coming back stronger.
And this idea, this resilience, is summed up perfectly with a quote from Ray Kroc, the guy who built McDonald's into a global empire. He basically said his success wasn't about being the most talented or the smartest guy in the room. It all came down to one thing, persistence. Just good old persistence. The sheer determination to keep going no matter what happens. That, he said, is all powerful. So when you boil it all down, the final message of the book is this. Just forget about looking for some secret formula or a magic indicator. That's not what this is about. Real success in trading comes from treating it like a serious business and, more importantly, having the mental toughness to get through the losses, because they will happen. So the real question you have to ask yourself isn't, can I find some secret strategy? The real question is, do I have the persistence to actually build this business from scratch, one painful, difficult trade at a time?
All right, let's talk about something that gets a lot of hype, day trading. You see this dream of financial freedom everywhere, but the reality? Well, it's often a whole lot of frustration. Today, we're going to tear this thing apart. We'll look at the dream, the cold, hard truth, and what it actually takes to make it. Let's get into it.
I mean, does this sound familiar? This right here is the hook. It's the reason so many of us get pulled in. The idea that you can be your own boss, call the shots from a laptop anywhere in the world, and just be free. It's a powerful, powerful promise. But what happens when that beautiful dream runs headfirst into a brick wall of reality? Well, here's that brick wall. You see, trading isn't a zero-sum game where for every winner there's a loser. No, it's actually a minus-sum game. Think about it. You've got broker fees, data subscriptions, exchange fees. There's a constant drain of money out of the system. That means the winners take home less than what the losers put in. The whole industry is literally built on a steady stream of people losing money. The game is tilted against you from the jump. So that brings up the million-dollar question, right? If the deck is stacked against us, and most people who try this are going to fail, how does anyone actually win? What's the secret sauce? Well, I can tell you it's not some secret indicator or a foolproof strategy you buy online. It's a complete shift in how you look at the entire game. Here's the shift. Successful traders stop trying to predict the future. Instead, they think like a casino. See, a gambler walks in hoping to get lucky on a single spin of the roulette wheel. The casino, on the other hand, doesn't care about any single spin. They know they're going to lose some hands, but they also know that over thousands and thousands of spins, their small statistical edge will guarantee they come out on top. That's the mindset. When you first look at a chart, it just looks like total chaos, right? A random, unpredictable mess of squiggly lines. It's kind of like looking up at the night sky, just a random scatter of stars. But our ancestors learned to see patterns in those stars, constellations that could guide them across oceans. In the same way, traders learn to spot recurring patterns in the market's chaos. These patterns don't predict the future, but they do give you a statistical edge. And the key to understanding that edge is something called conditional probability. Now that sounds super academic, but it's a really simple idea. New information changes the odds. The problem is our brains are, well, they're pretty terrible at guessing how those odds change. So let's put our intuition to the test with a classic brain teaser that messes with almost everyone. Okay, picture this. You're on a game show. There are 3 closed doors. Behind one, there's a brand new car. Behind the other 2, goats. You get to pick one door. Let's say you pick door number 1. Now the host, who knows what's behind every door, walks over and opens one of the doors you didn't pick, say door number 3, and behind it is a goat. So now there are 2 doors left. Your original pick, door number 1, and the other one, door number 2. The host looks at you with a smirk and asks, do you want to switch to door number 2? Now, what does your gut tell you? It feels like it's 50-50 now, right? Does it even matter if you switch? And this is where our intuition just completely fails us. The answer is not 50-50. You should absolutely 100% of the time switch doors. Why? Because when you made your first pick, you had a 1 in 3 chance of being right. That means there was a 2 in 3, or 66% chance, that the car was behind one of the other 2 doors. When the host opened one of those doors and showed you a goat, he didn't change the past. He just gave you new information. He concentrated that entire 66% probability onto the one other door left. By switching, you're basically flipping your 33% chance for a 66% chance. And that's the whole point of this puzzle. Your gut feeling is often dead wrong when it comes to probability. Success in trading isn't about what feels right or getting lucky. It's about knowing the real mathematical odds of your strategy and then executing it over and over, accepting that the small losses are just the price you pay to play a game you know you can win in the long run. Okay, so if thinking in probabilities is the what, then how do you actually do it? Well, it all boils down to building your career on 3 fundamental pillars. So first, you've got the mechanical stuff. These are your tools, your software, your charts. Then there's the technical. This is your strategy, your how-to, learning chart patterns, managing your risk. And finally, you have the psychological pillar, your mindset, your discipline, your ability to keep your emotions in check. So where do you think successful trading comes from? And here's the part that is a total game changer, and it's where almost every new trader gets it backwards. They spend all their time obsessing over the 20%, the perfect strategy, the best software. But if you talk to any trader who's made it, they'll tell you that success is like 80% psychology. The real battle isn't on the screen. It's right between your ears. So let's dive into that massive 80% slice, shall we? Why is mastering your own brain so much more critical than mastering a chart? And what's the one psychological trait that really stands above everything else? Because this is what blows up more trading accounts than anything else, making decisions based on emotion. It's fear making you sell a good trade way too early. It's greed making you hold a loser way too long. And it's that dreaded revenge trading after a loss, where you just throw your whole plan out the window trying to get your money back fast. These emotions are the enemy of discipline, and without discipline, your statistical edge is worthless. I mean, think about it. Everyone has access to the same charts. The winning strategies, they're not secret. They're in books, they're online, they're everywhere. We all have access to the same 20%. So the real difference, the thing that separates the winners from the losers, has to be in that other 80%. It comes down to one single quality. And that quality is resilience. It's toughness, for sure, but it's more than that. It's the ability to take a punch. And believe me, in trading, you're going to take a lot of punches. And not just get back up, but get back up with your game plan and your discipline 100% intact. It's trusting your process, even when you're on a losing streak. Let me tell you a quick story. Back in 1983, a guitarist named Dave Mustaine got fired from his band, Metallica. This was right before they recorded their first album and became one of the biggest bands on the planet. It was a soul-crushing setback. But on the long bus ride home, he got angry. He decided he was going to start a new band that was so heavy, so successful, that his old band would regret it forever. That new band was Megadeth. That's resilience. Now, let's look at the flip side. In 1962, a drummer named Pete Best got fired from his band, the Beatles, again, right before they exploded into global superstardom. It was the exact same devastating career blow. But Pete Best crumbled. He fell into a deep depression, struggled with alcohol. Two almost identical setbacks, two completely opposite outcomes. The only difference was resilience. And this quote from Ray Kroc, the guy who built McDonald's into an empire, just says it all perfectly. You can be talented, you can be a genius, you can have the best education. None of it matters without persistence. In trading, the market is going to test you constantly. Your ability to just keep going, to stick to your rules with absolute determination, that's the superpower. So I'll just leave you with this to chew on. Forget the fancy strategies and the expensive software for a minute, and just look inward. In a game that is literally designed for you to lose, where the emotional pressure is relentless, is your resilience, your simple, stubborn persistence, your single greatest asset. Because in the end, that is what separates the dream from the discipline. So you're thinking about becoming a day trader. Awesome. In this explainer, we're going to open up the toolbox and show you every essential piece of gear you'll need to get started. Here's how we're going to break it down. We're going to start with the one big rule that trips everyone up. Then we'll talk about how to pick the right partner in all this, your broker. From there, we'll take a tour of your trading cockpit, learn the actual buttons you'll be pressing, and then wrap up with the most important part, how to protect yourself. Before you can even think about making your first trade in the US, you're going to run into this number, $25,000. It's a big one. So what's the deal with 25 grand? Well, it's basically the key that unlocks your ability to trade as much as you want. And it all comes down to a single, really important rule that was actually designed to keep new traders from blowing up their accounts. Okay, let's tackle this head on. This whole $25,000 thing is because of something called the pattern day trader rule. The PDT rule is basically the biggest gatekeeper for anyone new to trading in the US. Here's the gist. If you make 4 or more day trades, that's buying and selling the same stock on the same day, within a 5-day window, boom, you get flagged as a pattern day trader. Now, the most important thing to get here is that this rule isn't trying to stop you. It's meant to be a safeguard. Regulators put it in place to protect folks with smaller accounts from getting chewed up by the markets. And they're serious about it. If your account balance dips below that $25,000 mark, your day trading ability is frozen, just stopped. So that rule naturally leads you to your first huge decision. Which broker are you going to use? And believe me when I say, this is one of the most critical choices you're going to make on this journey. Because of the PDT rule, you basically have 2 paths. You can go with a US broker, which is heavily regulated and has to enforce that $25,000 rule, no exceptions. Or you can look at offshore brokers. They don't have to follow the PDT rule, which is tempting for smaller accounts, but, and this is a big but, it comes with a lot more risk because they're not under US protection. But it's not just about where the broker is located. It's about how they work. You've got your conventional brokers, who are great for long-term investing. They give you research and advice, but their trades can take seconds, even minutes to go through. For a day trader, that's an absolute eternity. That's why active traders almost always use direct access brokers. We're talking about execution speeds in fractions of a second. It's all about speed. All right, you've got your broker. Now you're going to be living inside their trading platform. You really need to think of this as your mission control, your command center for everything. Okay, I know, you look at this for the first time and it seems insanely complicated, right? Like something out of a sci-fi movie. But trust me, don't let it intimidate you. It's really just a handful of key windows, and each one has a very specific job to do. Let's break it down. Think of it like this. You've got 2 different views of the world. On the one hand, you have the top list, which is like a bird's eye view of the entire market, showing you which stocks are making the biggest moves right now. And on the other hand, you have your market view. That's your personal watch list, the specific stocks that you care about and are tracking closely. And then you have this. This is the montage or level 2 window. This is the heart and soul of the whole operation. This is where you see the live supply and demand for a stock, all the buy orders and all the sell orders lined up and waiting. This is the pulse of the market. And this is where you'll actually execute your trades. Okay, so you're sitting in the cockpit, you know what all the gauges do. Now it's time to actually fly the thing. We need to talk about the different ways you can buy and sell, because getting this wrong can cost you big time. This quote says it all. The most basic way to trade is with a market order.
And it is exactly like signing a blank check. You're basically telling your broker, I don't care what the price is, just get me in or out now.
And this chart shows you exactly why that's so dangerous. This is something called slippage. It's when you hit the sell button expecting to get, say, $10 a share, but by the time your order is filled, the price is plummeted, and you end up with 5. It's a nasty surprise, and it happens in a blink of an eye. For some traders here, it was a total disaster.
So how do you protect yourself from that? Well, you can use a limit order, which says you'll only trade at a specific price or better. The downside is your order might never get filled. Or you can use what the pros use, a marketable limit order. It's the best of both worlds. It gives you the immediate execution of a market order, but with a price limit to protect you from catastrophic slippage. It's all the speed with a crucial safety net.
Now, to use these orders effectively, you have to be fast, lightning fast. So fast that clicking a mouse is just too slow. That's why pros use hotkeys. These are custom keyboard shortcuts that let you send your orders instantly. In a market that moves in milliseconds, that speed isn't just an advantage, it's everything. All right, last up, and this is probably the single most important tool in your entire toolkit. This is all about how you protect your money when a trade inevitably goes against you. We're talking about the stop-loss order. The best way to think about this is as your automated ejection seat. It's an order you set up ahead of time that will automatically get you out of a bad trade before the loss becomes too big to handle. And let me be clear, this is not a suggestion. This is a non-negotiable rule of responsible trading. If you buy a stock, you set a stop loss below your purchase price. If you short a stock, you set it above. No matter what, it's your safety net. It takes the emotion and the guesswork out of cutting your losses. So as you can see, trading isn't about getting lucky or having a magic crystal ball. It's about understanding your tools and using them with discipline. From the rules of the road, to your broker, to the orders you use, being prepared is your single greatest asset. So now you've seen the whole toolkit. What's next? Well, the most important journey is the one from knowing the stuff to actually doing it. And the best part is, you don't have to risk a single penny to start. Almost every broker out there offers a trading simulator. Get in there, practice, and master these tools in a safe space. That is, without a doubt, the most important first step you can possibly take.
All right, let's get right into it. Every single new trader, and I mean every trader, eventually hits this wall. You've studied the strategies, you've got your platform all set up, but when that opening bell rings, what on earth do you actually trade? It's a huge problem, and in this explainer, we're going to build a step-by-step blueprint to solve it once and for all.
You're going to hear this over and over from pro traders, and believe me, it is brutally true. You could be the best chart reader in the world, but if the stock you're watching is just sitting there, not moving, you're just burning daylight. You're wasting your time, your focus, and your money. A flat stock is a lost day, simple as that. And this right here is the heart of the frustration for so many people starting out. You might understand the patterns, you know your rules for getting in and out of a trade, but if you can't find the right stocks to use those skills on, well, you just end up getting chopped to pieces by the big algorithms. It feels like you're bringing a knife to a gunfight. So that's exactly what we're here to fix. So what's the secret weapon? What do the pros do? Well, it's not about trying to trade everything that moves. No way. It's about being a sniper, not a machine gunner. You have to be incredibly selective. Experienced traders are like hunters, and they're looking for a very specific type of prey. They are hunting for what we call stocks in play. This concept is the entire key. So what in the world is a stock in play? Well, it's not just some random stock that's moving a lot. It's a stock that is serving up high-quality, A-plus trade setups on a silver platter. We're talking about opportunities where you could make 5, 10, maybe even 20 times what you're risking. These are stocks that have a certain rhythm, a kind of personality, with moves that are actually catchable if you know what you're looking for. Okay, so how do we spot these things in the wild? There are 4 key ingredients you gotta look for. First, there has to be a catalyst, some kind of fresh news, like an earnings report or an FDA announcement. Second, it's gapping up or down more than 2% before the market even opens. Third, it's got a ton of trading volume in the pre-market. And finally, and this one is so important, it's trading with high relative volume. That means it's trading way, way more than it usually does. And here's the magic. A true stock in play has what traders call alpha. It's like its own little universe. It moves because of its own story, its own news. It couldn't care less what the S&P 500 or the NASDAQ is doing. That independence, that's where we as retail traders can find a real edge. And boom, here's a perfect picture of what I'm talking about. Just look at this. On the right, you've got the S&P 500, the SPY, and it is selling off hard. It's a sea of red. But at the exact same time, look to the left at stock LB. It is ripping higher, completely ignoring the rest of the market. That, my friends, is a stock in play, marching to the beat of its own drum. So you're sold. You want to find these stocks. Where do you start? Well, our hunt begins in the dark, before the market even opens for the day. This is the prep work. This is where you lay the entire foundation for a successful trading day by building your morning watch list. Now, how do we search through, 7,000 plus stocks? We're not going to do it by hand. We use a powerful tool called a scanner. And this isn't guesswork. We're giving it very specific instructions. As you can see here, we're telling it, hey, only show me stocks gapping more than 2% with a decent price and a ton of pre-market volume. This simple filter takes that massive universe of stocks and shrinks it down to just a handful of the best potential candidates. Okay, so your scanner works its magic and spits out a list of, say, 10 stocks. That's awesome, but you can't trade all 10. You'd go crazy. So the next logical question is, how do you whittle that list down? How do you separate the good from the great and build your final A-plus watch list for the open? The answer is always in the charts. You have to pull up the pre-market chart for every single stock on that list, and you're looking for two things: clean, crisp price action and healthy, consistent volume. You're not just looking at the numbers, you're looking for the quality of the activity. So what's good versus bad look like? Well, a good candidate has volume that's spread out over time, not just one giant weird spike. It's making clean moves, setting obvious levels of support and resistance. It looks alive. It looks tradable. A bad one, it might have huge volume, but the price chart is flat as a pancake, totally lifeless. It just looks untradeable. Here is a textbook side-by-side example. On the left, we've got INCY. See how the volume is distributed and the price is making those nice, clean swings? Beautiful. That's what we want to see. Now look at ALR on the right. Whoa, massive volume, right? But the price is a dead flat line. This is a classic trap. It's almost always a buyout where the stock price is already fixed. It's got all the volume in the world, but there is zero trading opportunity there. Okay, but what if you do all this pre-market work and crickets? Nothing. The market's totally quiet. Does that mean you should just pack it in and go watch Netflix? Absolutely not. This is when we pivot. We switch to our second method, using real-time scanners to find stocks that pop up after the opening bell. These scanners are your eyes and ears on the market, constantly running in the background. They're looking for things we tell them to look for. So, for example, a new high of the day scanner will scream at you the moment a stock breaks out. Another one might flag stocks that are breaking a key technical level, like VWAP. They basically tap you on the shoulder and say, hey, pay attention, something's happening over here. All right, you found a stock in play. You're hyped up, you're ready to trade, but wait, hold on. This is a step that so many new traders skip, and it is a massive, costly mistake. You have to know what kind of battlefield you're stepping onto. You have to understand the type of stock you're dealing with, because that tells you everything about the risk involved. Generally, we can break stocks down into 3 classes based on their float, which is just a fancy word for how many shares are actually out there for people to trade. You've got your low floats with less than 20 million shares. They're usually cheap, and their volatility is, well, it's extreme. Then you have medium floats, which are kind of the sweet spot. And finally, you have your large floats, the giant blue chip companies, which tend to be much less volatile day to day. Now listen up, because this is crucial. Those low float stocks, they are where you see those mind-bending, absolutely explosive moves. They offer truly massive reward potential. But, and it's a big but, they come with an equal, if not greater, amount of risk. They are a true double-edged sword. And this is what that extreme volatility looks like. On the left, CNET ran over 600% in a single day. On the right, Archon jumped almost 300%. These are the lottery ticket moves that attract new traders like moths to a flame. But man, they are so dangerous. They can reverse just as fast and wipe you out in seconds. I need to be really, really clear about this, so I'm just going to say it. Trading and losing money on low-float stocks is the #1 reason new traders blow up their accounts. Period. The temptation is huge, I get it, but you have to earn the right to trade these. Focus on the medium float stocks first. Learn the craft, build your skills, and then maybe, just maybe, you can step into that high-risk arena. Okay, let's bring it all home. We have covered a ton of ground here, from hunting in the pre-market to understanding risk. So let's put it all together into your daily trading blueprint, the exact process you can start using tomorrow morning to build a professional level watch list. Here it is, your 5-step action plan. Step 1, you scan using your pre-market criteria. Step 2, you analyze the charts in the news for each candidate, dodging those buyout traps. Step 3, you build your final focused watch list, just 2 or 3 of the absolute best. Step 4, you adapt. If the pre-market's dead, have your real-time scanners ready to go. And step 5, before you even think about clicking a button, you classify that stock so you know the risk you're taking. And that's it. That is the complete process. You've gone from staring at a confusing screen of thousands of stocks to having a short, focused, manageable list of high-potential candidates. You've done the hardest part. You've built your watch list. So the only question left to ask is, what's your plan to trade it?
You ever see that thing the market does where it seems to just remember certain prices? I mean, days, weeks, even months can go by, and then a stock will just stop dead in its tracks at a price it hit way back when. It's wild, right? Well, today we're going to dig into one of the most crucial skills in trading, finding real support and resistance. And let me tell you, this is way more than just drawing a few lines on a chart. This is about learning to read the market's collective memory.
But first, check this out. This is kind of crazy when you think about it. You can have 2 traders looking at the exact same chart at the exact same time. One of them sees a clear rocket ship to the moon. The other sees a sinking ship. So, who's right? Well, that very question points to a massive problem with how a lot of people try to read charts in the first place.
Okay, so here's the deal. The author of our source material comes out swinging with a really strong opinion. Those diagonal trend lines you see everywhere, they can be super misleading. And why is that? It's because they're basically a product of wishful thinking, not cold, hard data. It is way too easy to just, connect a couple of dots in a way that confirms the trade you already want to make. You end up telling yourself a story you want to hear.
All right, so if those diagonal lines are basically junk, what do we use instead? What can we actually trust? The answer is beautifully simple. Horizontal levels. See, the market doesn't really remember slopes or angles, but what it does have is an almost photographic memory for specific prices. And this is where we get to tap into the real deep psychology of the market.
Let's break it down. First up, we've got support. The easiest way to think about this is like a floor or a safety net under the price. It's a price point where a whole bunch of buyers are just waiting, ready to jump in. They create so much buying pressure that they totally absorb all the selling, and it stops the stock from falling any lower. It's basically a level where everyone kind of agrees, hey, this is a good price to buy.
And on the flip side of that, you've got resistance. If support is the floor, well, resistance is the ceiling. This is a price where sellers come out in full force. They're either cashing in their profits or they're starting to bet against the stock. Either way, they overwhelm the buyers and put a lid on the price, stopping it from going any higher. It's the market saying, whoa, okay, that's high enough for now.
So you might be thinking, what's the magic here? Is there some secret formula? Well, the truth is, there's no magic at all. These levels work for one simple reason: a ton of traders. We're talking everyone from little guys like us to the massive institutional desks are all staring at the exact same prices. And when enough people believe a level is important, their combined buying or selling actually makes it important. It's a classic self-fulfilling prophecy. Just herd mentality 101.
Okay, this sounds great, but where the heck do we even start looking for these levels? Well, the best place to begin is with the easy stuff, what we call the automatic levels. These are the price points that are so important and so universally watched that most trading platforms can just plot them on your chart for you. Think of them as your chart's built-in GPS.
So you can basically break these levels down into 2 camps. You've got your predetermined levels. These are the no-brainers, the ones the software finds. And then you have discretionary levels, which you have to find yourself. We're going to start with the automatic ones first, because they require zero guesswork.
All right, pop quiz time. If you could only have one level on your chart, just one, what do you think would be the most psychologically important price for a day trader carrying over from one day to the next? Any guesses?
You got it. It is the previous day's close. Think about it. It's the final score of yesterday's game. It's the last price everyone agreed on before the closing bell. So every single person, from the biggest funds down to the smallest retail traders, uses that price as the starting line for the new day. It's the ultimate reference point.
And let's see this in action. Take a look at this chart for Juno. For weeks, the price just could not get past that 30.75 level. It tried once, got rejected, tried twice, got rejected again. Then it finally closed there. And the moment it broke through that price the market had remembered for so long, boom, it gapped up hard. That is not a coincidence, folks.
Here's another way to use it. Check out MNK. The stock is looking pretty weak right at the open, so a trader shorts it. Now, the big question is, where do I take my profits? Well, look no further than, the previous day's close at 46.52. It acts like a magnet, and sure enough, the price gets pulled right down to it. A perfect target.
And it works just as well as a floor. On this CUDA chart, the stock is just tanking at the open, selling off hard. But bam! Look where it slams on the brakes and bounces, right off the previous day's close. And that wasn't a fluke. It came back down for a second try later in the day, and the level still held firm. That tells you a lot about how respected that price is.
Okay, so let's put it all together. Here are your 5 automatic must-have levels you should have on every single chart. You've got the previous day's close, which we've just seen is an absolute beast. Then you add yesterday's high and yesterday's low. And then you go back one more day and grab the high and low from 2 days ago. These 5 points immediately give you a battleground map for the day. All right, so you've got your automatic GPS levels all plugged in. Now for the fun part. It's time to move on to developing your own trader's eye and finding the important levels that the software won't show you. This is where the art of trading really starts to meet the science, and honestly, it only comes with practice. We're going to zero in on 3 big ones here. First, the high and low that gets set during pre-market trading. Second, a few of the key moving averages that all the big institutions and their algorithms are watching. And third, and maybe most importantly, the major turning points you can find by looking at the daily chart's history. Let's start with those pre-market levels. These are huge because they basically set the stage for the trading day. Look at this AVEO chart. Before the opening bell even rings, a high and a low have already been established. So what happens when the market opens for real? Yep, the price plays ping pong right between those 2 levels, using the pre-market high as a ceiling and the pre-market low as a floor.
Now, this is a super important point. Not all levels are created equal. There is definitely a pecking order, and the rule is simple. The bigger the time frame, the bigger the deal. A level you spot on a daily chart, that's like a heavyweight champion. It carries a ton of weight. A level on a 5-minute chart, it's more of a lightweight. Same thing with moving averages. A 200-day average is way more significant than a 20-day one. Okay, so here's your homework. Go pull up a daily chart of a stock you follow. Start scrolling back in time, weeks, months, even years. You are on a treasure hunt. You're looking for those big, obvious historical turning points where the price made a dramatic reversal. These aren't just old data points. They are the market's scars and memories. And I absolutely love this quote from our source material because it just nails it. The best, most reliable levels, they aren't subtle. They're not hidden. They should be so obvious that they practically jump off the chart and grab you. What does that mean? It means if you're squinting at your screen asking yourself, is that a level? Then it probably isn't one. The real ones are obvious.
So let's be super clear about something. Finding all these levels is not about getting a crystal ball that predicts the future. It's not going to happen. Think of them more like tools you use to build your own personal trading map for the day. You're just marking the key locations on the map where you expect a big battle between buyers and sellers to go down. And the source material ends with this fantastic analogy. It compares trading to being a pro athlete, and it makes so much sense, right? Learning to spot all these levels, that's like running drills in practice or studying the playbook. But knowing the playbook doesn't win you the championship. It all comes down to your execution on game day, how you perform in the heat of the moment. So there you have it. You've got the toolkit, you've seen how to start building your own market map. The only question left is, what are you going to do with it? What's your training plan going to look like? How are you going to put in the screen time to really train your eye to see these things instantly? Because learning about it is one thing, but putting in the work, that's what turns knowledge into a real profitable skill.
Welcome to The Explainer. Today, we're going to decode the secret language of the financial markets. It's not written in words, but in these strange little shapes called candlesticks. You know, at first glance, a chart like this just looks like a total mess, right? It seems like random, unpredictable noise, an intimidating wall of data that doesn't seem to have any story to tell. But what if I told you that's not noise at all? What if it's the story of a battle? We're going to show you how to read this not as boring data, but as a compelling story of conflict, psychology, and raw power playing out in real time. All right, so to read the story, you've got to learn the alphabet first, and that alphabet is a single candlestick. So each one of these little candles, it's like a snapshot of a battle over a specific time frame. Could be a minute, could be a day. And it packs in 4 crucial bits of info: the opening price, the highest and lowest points the fight reached, and where things ended up at the close. This is our fundamental building block. Okay, so that thick part of the candle, that's the body. It tells you who won the main fight. If the body is green, the price closed higher than it opened. Boom, buyers won that round. If it's red, well, the price closed lower. That means the sellers took control. And what about those thin lines sticking out? Those are the wicks. They show you the full chaos of the conflict. They reveal just how high the buyers managed to push and how low the sellers were able to drag things down before that final bell. Okay, so we've got the alphabet down. Now let's meet the characters, the 2 main fighters in this battle that's happening every single second of every trading day. So in one corner, you've got the bulls. They're the optimists, always trying to charge prices higher. And in the other corner, you have the bears, the pessimists, always trying to swipe prices down. These 2 are in a constant tug of war for control. And then there's the crowd, right? The undecided traders just waiting on the sidelines. But here's the thing. Their presence creates this massive sense of urgency. The bulls feel like they have to buy right now before prices shoot up, and the bears feel like they got to sell right now before they drop even more. And that leads to this really crucial point. This quote just nails it. Trading is the study of mass psychology. So reading a chart isn't about doing some crazy complex math. It's really about being a psychologist, watching human emotions, fear, greed, play out on a massive, massive scale. Okay, so let's see how this all comes together. When you combine a few candles, it's just like putting letters together to form words. You start to see these simple but really powerful plot points emerge in our story. Now look, if you go online, you're going to find hundreds of these patterns with these crazy, fanciful names. But the author of our source material, he argues most of them are just wishful thinking. You know, it's like seeing shapes in the clouds. So let's just cut through all that noise and focus on what's actually practical. We're going to start with a really powerful, simple pattern that our source author totally trusts: higher highs and higher lows. And this pattern is, well, it's as simple as it sounds. Each new candle is basically pushing the boundaries of the last one. It's a clear signal that the buyers are being aggressive, they're in firm control, and they're just constantly marching the front line of this battle higher and higher. All right, next up, we have a pattern that signals a really dramatic shift in momentum. I want you to think of this one like a surprise victory in the middle of a battle, something that completely changes the course of the whole fight. Yeah, this is just a massive show of force. The bullish engulfing pattern shows that the buyers didn't just stop the seller's progress. No, they completely overwhelmed them. This often signals that a whole downtrend might be about to flip and reverse. But hey, what happens when the fight is a draw? Well, that's where the doji comes in. When you see this candle with its tiny little body, or sometimes no body at all, it's a sign of a truce. It's a stalemate. Both sides are basically exhausted, and neither one could gain the upper hand. But even in a stalemate, the wicks tell a story. Just look at the shooting star. See that long upper wick? That shows the buyers made a big charge but got beaten back, a classic sign of exhaustion. Now the hammer. That long lower wick shows the sellers tried to drag the price way down, but the buyers fought them off. These are really subtle but powerful clues about who might win the next round. Okay, now for the climax. Let's take everything we've learned and apply it to a real trade example from our source material. Let's watch this story unfold in a real-world scenario. So, the story here started with this sharp drop right when the market opened. Sellers were clearly in charge, and the trader, well, he placed a bet that they'd keep pushing the price down. But then, the plot changed. And this just brilliantly illustrates the power of reading the story in real time. The initial plan to short, it was sound, but then came the twist. The sellers started losing steam. And then the clue appeared, that simple higher highs pattern we talked about, signaling a comeback from the buyers. The chart was literally telling a new story, and the key was to listen and adapt. So, really, the key takeaway is this. You've got to stop seeing charts as just a bunch of lines and numbers. You need to start seeing them for what they are.
the real-time unfolding story of a psychological war between two incredibly powerful forces.
By learning to read this language of candlesticks, you're not predicting the future, but you are getting a deep understanding of the present balance of power. You have the alphabet now, so the only question left is, what stories are you going to find hidden in the charts?
Welcome to The Explainer. Today, we're jumping right into two pretty advanced day trading strategies designed for people like you and me, the retail traders, in a market that's just, well, dominated by machines. This is the underdog's playbook.
So let's start with the number that kind of sets the stage for everything we're about to talk about. Over 60%, 60% of all trading on the stock market, it's not even done by people. It's all high-frequency algorithmic computers.
I mean, that sounds like a total David versus Goliath situation, right? An impossible fight. But, as trader Andrew Aziz puts it, you don't actually have to beat the machines at their own game. His whole point is that we, the people, the regular traders, we can overpower the computers.
So think about it this way. Trying to trade against these algorithms, it's like playing chess against a supercomputer. You might win a game here or there, but eventually you're going to lose. But what if you could just pick a completely different battlefield? That's exactly where we find our edge.
And right there, that's the secret sauce. Instead of trying to fight these algorithms across the entire market, which is a losing battle, you focus. You zero in on just a small handful of stocks each day where there's so much interest from traders like us, the retail crowd, that we are the ones calling the shots. Our volume is what moves the price.
All right, so let's get into it. Our first secret weapon, if you will. It's a really powerful strategy, especially for what are called low-float stocks, and it's known as the fallen angel.
So the whole idea here is to ride these insane waves of volatility. We're on the hunt for stocks that have a really limited supply of shares, that's the low float part, and have some big news attached to them. See, with fewer shares out there, it doesn't take much buying or selling to create these huge explosive moves, both up and down. So they spike up, they get hammered down, and then they can offer this incredible slingshot move right back up.
Okay, so what's so cool about this is how it breaks down into 4 really clear steps. First, you get that morning spike. Then comes the fall, a pretty dramatic one. After that, there's this pause, this consolidation, where the stock just kind of catches its breath. And then finally, you get the rebound. And that's our signal.
Okay, talk is cheap, right? Let's look at a real-world example. So here's a stock SMIT. And man, it had all the perfect ingredients. A super tiny float of just 2.7 million shares, a massive 70% gap up before the market even opened, and a ton of pre-market volume. This thing was screaming fallen angel setup.
And boom, here's the pattern playing out perfectly. The market opens, SMIT rockets up to $4.36, and then bam, it just gets slammed down to $3.70. But look at the chart. It doesn't just keep falling. It holds that level, it consolidates, and then, right around 10:05 a.m., you see that breakout move on a huge wave of volume. That is the textbook entry signal right there.
So, what was the payoff? Well, here it is. By seeing that setup, waiting for the signal, and then pulling the trigger, the trader from our source material walked away with a profit of over $880 on one single trade. It just goes to show you how effective this can be.
Okay, but let's be super clear. This isn't just random gambling. To trade this, you have to be incredibly disciplined. It's all about the rules. The stock has to be a low-float stock in play. That's what fuels the fire. And you absolutely cannot jump the gun. You have to wait for it to consolidate and find that support level. That proves the panic is over. And probably the most important rule of all, that breakout has to happen on massive volume. Volume is your proof. If it's not there, you just stay on the sidelines. Simple as that.
All right, let's switch gears and look at our second strategy. It actually builds on a lot of these same ideas about predictable patterns. This one is maybe one of the most classic, most reliable setups in all of day trading, the ABCD pattern.
So you might be thinking, wait, if this is so well known, doesn't that mean it stops working? Well, funnily enough, its power actually comes from its popularity. When you have thousands and thousands of traders all looking at the same chart, seeing the same setup, their combined buying and selling can create this, self-fulfilling prophecy. The old saying is true. The trend really is your friend with this one.
And the logic behind it is just so simple and elegant. First, you get this strong, aggressive move up. That's your A to B leg. Then, people who got in early start to take some profits, and that causes a little pullback, right? That's your B to C leg.
The stock holds at point C, finds a new floor, and then a new wave of buyers comes in, pushing it right past that old high, on its way to point D.
And check this out. The chart for OPT shows this perfectly. You've got that huge surge from A to B. Then it pulls back, and it carves out a really clear support level at C. Now, the ideal entry is somewhere near C, with your stop loss tucked right below it, because you're anticipating that next big push up. And that breakout past B, especially on that volume spike, that's your green light to ride the momentum.
Okay, now this is a really important point. On the left, you've got the 5-minute chart for AMD, and you can see the general pattern, sure. But look over at the 1-minute chart on the right. See how much clearer it is? It lets you absolutely pinpoint a much more precise entry at point C. And what that means is you can set a tighter, much less risky stop loss. Using different time frames like this is a huge advantage.
And yeah, just like the fallen angel, success with the ABCD pattern all comes down to following a strict set of rules. You have to wait for that pullback to point C. That's what shows you the stock has found a solid base. You enter near that support with a clear stop loss right below it. That's how you protect your money. You skim some profits at the old high, because that's a natural spot for it to pause, and then you just manage the rest of the trade based on what the chart is telling you.
So, okay, we've just walked through two really powerful, time-tested patterns. But here's the thing. Just knowing the X's and O's of the playbook, that's not enough. The real edge, the thing that makes these patterns actually profitable over the long haul, is all about the mindset. It's what separates the consistent winners from, well, everybody else. See, the goal isn't to know 50 different strategies. You're not trying to be a jack of all trades. The real secret is to master just one or two of these setups so deeply that you can spot them instantly, that you can execute them flawlessly, without second-guessing yourself, without letting emotions get in the way.
And that really brings us to the most important takeaway of all of this: what it actually means to master your edge and to really thrive in this super competitive world.
You know, when you boil it all down, it doesn't matter if you're trading a fallen angel or an ABCD pattern. These three pillars are universal. They apply to everything. First, volume. Volume is what confirms the move. It's proof that other traders see the same thing you do. Second, always have a stop loss. It protects your trading capital, which is the most important asset you have. And third, discipline. Discipline is the glue that holds it all together and makes it work in the long run.
And honestly, that's the ultimate question, isn't it? The strategies are out there. The patterns repeat themselves over and over. But success, it's not determined by knowing the playbook. It's determined by having the discipline to actually follow it, day in and day out. And that's a question only you can answer for yourself.
Have you ever been there? You're in a trade, it starts to go against you, and you just hold on. You're hoping, maybe even praying, that it'll turn around. But all you do is watch a small, manageable loss spiral into a catastrophic one. If that sounds familiar, you are definitely not alone. It is the single biggest reason why most traders fail. But what if I told you the fix has almost nothing to do with finding a better strategy? It's all about one thing: surviving long enough to win. And today, we're going to break down exactly how to do that. I mean, this is the question, right? It haunts the entire trading world. Why do so many smart people, armed with all the books, courses, and fancy indicators, still end up blowing up their accounts? Well, they spend all their time and energy searching for that holy grail, that perfect entry signal that never, ever loses. But they are looking in the completely wrong place. You gotta love this quote from the legendary trading coach Van K. Tharp, because it just turns everything we think we know on its head. What he's saying is that your entry point, the thing that most traders obsess over, is way less important than how you manage your money and your risk once you're actually in the trade. That right there is the real game. So if strategy isn't the whole picture, what is? Well, I want you to think about successful trading like a three-legged stool. All three legs have to be strong and stable, otherwise the whole thing just comes crashing down. And here they are, the three legs: a proven strategy, sound psychology, and excellent risk management. Look, your strategy is important, you absolutely need an edge. But your psychology, your ability to stay cool and disciplined, and your risk management, the rules you use to protect your cash, are every bit as critical. If you take away any one of those legs, what happens? The stool collapses, every single time. And this is the trap that almost everyone falls into.
When a trader starts losing, their first instinct is to junk their strategy and go find a new one. A new indicator, a new guru, whatever. They think the problem is external. It's the market's fault or the strategy's fault. They don't realize the real problem is internal. It's their own mindset and a total lack of a risk management plan.
So what does it look like when this goes wrong in the real world? Hope, which is such a wonderful human emotion in everyday life, becomes absolutely lethal in trading. Let's look at two stories that prove this point perfectly.
These are actual emails from two different traders. We'll call them Sean and MD. And these are smart people. MD is literally a medical doctor. But both of them got trapped in losing trades, completely paralyzed by the hope that things would just turn around. You can feel the quiet desperation in their messages, and I bet a lot of you will recognize that feeling.
So what was their mistake? Well, it was the same one. Trader Sean had over half of his entire account tied up in just 4 losing trades. Trader MD was down 15 grand on a single position. And they both committed the #1 deadliest sin in day trading. They took a trade that went bad, and because they couldn't stomach the loss, they turned it into a hope and a prayer swing trade. And check this out. This is the chart of what Trader MD was holding. He bought near the top, around $40 a share, and then he just held on, praying for a recovery as it crashed all the way down below 10. He had no plan, no stop loss, just pure hope, and the market absolutely crushed him for it.
Okay, so how do we avoid becoming Sean or MD? It takes a massive shift in how you think. You have to learn how to be a good loser. I know, that sounds crazy, right? Loser is a bad word, but trust me, it is the absolute key to your survival in this game.
I absolutely love this quote because it's so real. Being profitable doesn't mean you never lose. It means you make sure your winning trades are bigger than your losing trades. Professionals lose all the time. 30, 40, even 50% of their trades are losers. The difference is they lose small. They cut the trade, they take the hit, and they move on. They have mastered the art of being a really good loser. See, your ego wants to be right. It wants to predict every twist and turn of the market. But your job is not to be a fortune teller. Your job is to be a trader. And that means you manage probabilities. And most importantly, you manage risk. You have to learn to accept that small loss and just move on. Live to fight another day, because there is always another trade.
All right, so how do we actually do this in the heat of the moment? We use hard, non-negotiable rules. I want you to think of these as protective armor for your trading account.
Rule number 1 is the 2% rule. This is your absolute line in the sand. You should never, ever risk more than 2% of your total account equity on any single trade. So if you have a $30,000 account, your maximum acceptable loss on one trade is $600. Period. No exceptions. Rule number 2 is the 6% rule. If your total losses for the entire month hit 6% of your account value from the start of the month, you stop. You're done. You close your live trading platform and you switch to a simulator for the rest of that month. This rule saves you from yourself when you're just not in sync with the market.
And this slide illustrates perfectly why you need both rules. The 2% rule protects you from the shark bite, that one giant catastrophic loss that just wipes you out. But the 6% rule, that protects you from the piranha attack, death by 1,000 cuts, where a long string of small losses slowly bleeds your account dry. You need armor against both of those threats.
Okay, so we have the rules, but how do we actually apply them when the charts are flying and the pressure is on? This is where we turn these ideas into real, concrete actions. First things first, you need a filter for what trades you're even willing to take, and that's your risk-to-reward ratio. Professionals only take trades where the potential profit is at least twice as big as the potential loss. So if you're risking $100 on the trade, you need a realistic chance to make at least $200. This discipline alone will change everything for you. Now for the most important math you will ever do as a trader, position sizing. It's a super simple 3-step process. Step 1, figure out your max dollar risk. Let's say you're risking 1%, which is $200. Step 2, look at your chart and figure out your risk per share. That's just the distance between your entry price and your stop loss. Let's say that's 50 cents. And step 3, you just divide. You take your max dollar risk, $200, and divide it by your risk per share, 50 cents. That gives you 400. That is the maximum number of shares you are allowed to trade. It's that simple. So we've covered strategy and we've covered risk management. But now we come to the final and frankly the hardest part of the puzzle, psychology. This is the real battle, and it's not fought on the charts, it's fought between your own 2 ears. This is from a trader we'll call Robert. He was actually doing pretty well, following all his rules. But then, after a couple of small losses and a silly mistake, something inside him just snapped. Instead of walking away like he should have, he went on a rampage. He started revenge trading. His own description of what happened is terrifying, and it's probably relatable if you've ever lost control. He said he turned into the Incredible Hulk. He knew he was breaking every single one of his rules, but he just didn't care. The logical trader was gone, and this savage animal just took over, trying to punch back at the market. And this really is the fundamental difference between a gambler and a trader. A gambler on a losing streak starts betting bigger and bigger because they think they're due for a win. A professional trader does the exact opposite. When they hit a losing streak, they reduce their size or they stop trading altogether. A gambler chases losses. A trader protects their capital at all costs. And really, everything we've talked about comes down to this one simple idea. You have to let go of the need to be correct on every single trade. Your ego is your absolute worst enemy in the market. Focus on your plan, manage your risk, control your emotions. Because your job isn't to be right. Your job is to make money. And in the end, that's the only job that matters.
So, you're thinking about getting into day trading, huh? You're probably wondering, is this a real path to financial freedom or just a super fast way to lose a lot of money? Well, today we're getting a major reality check from trader Andrew Aziz, who says the most important thing you can possibly do is figure out one simple thing. Is this career actually for you?
We've all seen that image, right? The dream? Making millions from a laptop, maybe on a beach somewhere, just a few clicks and you're set. It's a really powerful fantasy, I get it. But the actual reality? It's a whole world away from that picture. So let's pull back the curtain and see what it really takes.
Okay, first things first, and this is probably the biggest mental shift you have to make. Day trading is a serious profession. It is not a slot machine, it's not a hobby for your spare time, and it is definitely not gambling. It's a career, and it demands a professional level of commitment.
And honestly, that's our goal here today. The author, Andrew Aziz, he's super clear about this. He's not trying to sell you on some dream. He just wants to give you the straight, unvarnished truth, so you can decide for yourself if this is the right path for you.
You know, what's really interesting is how this guy builds his credibility. He doesn't shy away from the bad reviews. He actually puts them right in his book. One person says it's redundant and repetitive, and another one said the book was so negative, depressing, they couldn't even finish it. He includes this stuff to prove a point. He's not selling you a fantasy, he's showing you the reality, warts and all.
So, let's just get this crystal clear. Day trading is a science. It's a skill you have to learn, and honestly, it's a full-contact sport where you're up against some of the smartest people in the world. What it is not is a casual activity, and it is definitely not some get-rich-quick scheme.
And to show you just how serious this is, let me tell you about a guy named Trader Dwight. This is a real story. He emailed the author and admitted he was trading with real money while driving his delivery truck through New York City traffic. He even called it kamikaze trading. I mean, you can't make this stuff up.
And this right here, this is the whole problem in a nutshell. Dwight finally realized he was just getting lucky and then losing everything. He asked the perfect question: how am I supposed to learn on a simulator when I'm driving during market hours? And the simple answer is, you can't. It's impossible.
Which brings us to one of the biggest myths out there, the idea that you can just start making money right away. The reality is a long, pretty grueling, but totally necessary learning process.
So what does that process actually look like? Well, Aziz lays out a really clear timeline. For the first 3 to 4 months, you're only on a simulator. That's fake money, but with real-time market data. Only after that do you even think about using real money, and even then, it's very small amounts for another few months, just to learn to control your emotions. We're talking 8 to 12 months before you can even start to think of yourself as a seasoned trader.
Now, what's the cost of this education? It's about $1,000. That's for about 6 months of access to a professional simulator. And when you think about it, compared to the tens of thousands you might spend on an MBA or any other kind of professional training, it's a pretty small investment in what could be a whole new career.
But this right here, this is the kind of dangerous thinking that gets so many new traders in trouble. This is a real quote from someone who just couldn't accept the idea of practicing. And that refusal to learn on a simulator, it is a guaranteed way to blow up your account.
Because here's the thing, once you have the technical knowledge, the single biggest obstacle in your way isn't the market, it's not your strategy, it's not the software. The biggest obstacle is you.
It all boils down to one thing: self-discipline.
But for traders, discipline means something very specific. It means you make a detailed plan before a trade, your entry, your profit target, your stop loss, and then you execute that plan every single time without changing your mind when your emotions start screaming at you. Think of it like this. A trader at a big firm on Wall Street has a manager breathing down their neck. If they break the rules, they get fired. Simple as that. Their discipline is external. It's forced on them. But you, as a private retail trader, you don't have a boss. You can break every rule in the book and no one's going to stop you. Your discipline has to come entirely from within. This is why a lot of successful firm traders actually fail when they go out on their own.
And what's the number one thing that makes you break that discipline? It's that one little number flashing on your screen, your real-time profit and loss, or P&L. Watching that thing go from green to red, back to green, that's what makes you panic or get greedy and just throw your whole well-thought-out plan right out the window.
So how do you fight back against this? The advice is so simple, it's almost funny. Most trading platforms literally have a Hide P&L button. Use it, and if for some reason yours doesn't, a small piece of duct tape over that part of the screen works just as well. The point is, you need to trade your plan, not your P&L.
And all of this leads to the final and maybe the most critical mindset shift you have to make if you want any chance at success in the long run.
Your goal is not to make money. I'm going to say that again. Your daily goal is to trade well. The money, that's just a byproduct of making good, solid trades day after day. If you focus on making money, your emotions will take over. But if you focus on making good decisions, the money will take care of itself.
And trading well, that's the hard work. It's not about just sitting and staring at a screen. It's this constant lightning-fast analysis. Who's in control right now? The buyers or the sellers? What's the chart pattern? Where's the real volume? This non-stop questioning. That's the real work of a day trader.
And look, let's be totally honest. This is hard. In fact, Aziz says that becoming a consistently profitable trader might just be the hardest thing you ever do in your life. But the journey of mastering your own psychology, of building that ironclad discipline, that's an incredibly valuable experience whether you end up making millions or not.
So, we end up right back where we started, but with a new question. The goal isn't the money or the beach. The goal is mastering the process. It's about focusing on your execution, not the dollar amount. So the real question isn't, do you want to be rich? It's, are you ready for the process?